Welcome to the November 7th, 2022 Advance Reports for McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, President, McGowan Group Asset Management, the team that cares, a team of 10 devoted to fiduciary service to our affluent clients. And the reason that you should set your brainstorming time with McGowan Group Asset Management is evidenced right here in this video. We produce these each and every week for our clients to say what's going on in the markets, what should I do about it, and what's actually working right now. You're going to see examples of that throughout this short video, so be sure to subscribe. That way you won't miss updates in the future, and you can share the link with those that have asked you what you're doing with your finances. This is a great way to help clients make great decisions, and that's how we built YouTube McGowan Group. This, to start the day with the first chart, is the S&P 500 year to date, a minus 21%. Actually, the Friday rally was pretty positive, and so you're seeing that's cut to below a 20% loss for the year. At this point, it was a minus 26% loss. That's absolutely huge. And it was a miserable year for just the pure equity investor. The thing that happened this year because of the Fed tightening is the bonds didn't offset it. So if you were a 50-50 portfolio in a low-cost ETF structure, the Vanguard total bond market's down 17% for the year. So the bonds didn't help at all, much less the long treasuries, which got crushed. Yes, the Federal Reserve raised rates this week, 0.75% again. That's a total of 4 moves, 3% in this tightening cycle. Very aggressive, gets the base lending rate to 4%. That means the cheap money era is over, and they may raise again in December. But what happened? This is when the Federal Reserve went on their magical mystery tour, especially this right here, where they said, we're going to jack up the rates so high and we don't care if there's unemployment, we don't care if there's a recession, we just hate inflation. That was the implication of their magical mystery tour that the Fed did when in 1 week, 33 speeches by the Fed governors and presidents saying, we just want to keep our jobs, we don't care if you lose yours. Well, the markets don't like the beating of not knowing where they're going to stop and wait. And we're getting closer to that point, but that premise evidenced here by the fact that this week was actually flat as they raised the rates. And they didn't tell us when they're going to end, which would usually cause a huge rally like 2019. So where do we not want to be? Look at this. Remember the FAANG stocks? And they were all the rage. Facebook, Amazon, Apple, Netflix, Google. Well, I'll say this. They're not the FAANG stocks anymore. They've been defanged. And Facebook changed its name to Meta, whatever that is. And so it spells mange, like a mangy dog. Look at this. Meta down 74%. Amazon down 46%. Apple down 21%. Netflix down 55%. And Google down 42%. What happened? They were just grossly overpriced because everybody wanted to be there, including the QQQ index. Well, things like this lead to a shift. And where did the money go? Because this may be an extended shift from growth to value, because the growth here disappeared. I'll tell you where the big growth is after this slide. Merck up 32%, Bristol Myers up 30%, AbbVie up 11%, Unum, the insurance company, up 88%. Wow, I call those the medical dividends because Unum does some disability and medical insurance too. But that is an amazing, resilient performance. Well, not a recommendation for your portfolio until you come to the McGowan Group and get a plan. So what research at the end of 21 would have led to those names? Well, low price to earnings ratio, that's value, but continued growth and rising dividends. That's the theme for 2021. We want rising dividends. Wow, here's the energy infrastructure. Now they're up 31% for the year. And the exploration and production companies have taken the overall complex up over 50%, and they're raising dividends, and they look like growth stocks with huge increases in their earnings over last year. That's a wow. And so dividend increases, big earnings growth, and low multiples. This group is still probably 5 to 8 times cash flow. And if you could buy a rent house at 5 times cash flow, that'd be 20% a year. If it goes to 10 times, well, that's good price appreciation. And that's the math we're using in this sector. And we'll start to take profits next year, the year after, but gradually. Okay, is it a recession? And you keep hearing the recession word, global recession. Europe's already in a recession. What we learned in 2011, 12, 13 is Europe can have its own little pity party recession, and the United States can just keep right on going. Now, whether that's true or not, well, let's see what the forecast is. Okay, real GDP change quarter over quarter. It projects that we will be another 0.6% real GDP growth above last quarter here in the fourth quarter. Okay, so we were 2.6 last quarter. We had the real definition of a recession built in right here. And so 2 quarters, Q1, Q2, yes, it was the official definition of recession, but it was because inflation temporarily ran hotter than the dollar growth in the economy. That's called a stealth recession. Now, we've got real forecasts out here. First quarter 23 is supposed to be a minus 0.1%. So you're going to hear all this talk about a recession during the first quarter before they announce that in April. So the recession talk isn't gone, but 261,000 net new jobs last month in October, well, that's not a recession. If you see that number going negative on actual jobs, net new jobs being negative, well, that tells you that there's a substantial change to the downside. This forecast says anemic real growth next year. It doesn't say recession, at least not yet. So that says we could get Goldilocks. We have the growth slows down and begins to reaccelerate, which we see out here at 1.5% for Q1 of 24. And inflation has already become disinflation. We covered that evidence in the last video. Go back there and you can see in the prior videos we've covered that you're actually getting some pockets of deflation. The housing market, according to the numbers we're seeing, could be a 20% deflationary gap over this winter time from what people thought they could get or what something they thought it was worth to what they can actually get with 7% mortgage rates. How are companies doing in profit, right? Because the value of a business, that's the S&P 500 for the blue chip companies, most of them have reported. So are earnings going down? No. Real earnings growth, 3%. It's anemic, not too hot, not too cold, but you got anemic growth on the earnings side. That's a Goldilocks situation after 3 bear markets in 5 years. We could land in a soft landing, not too hot, not too cold. You hear so much negative news, I wanted to cover, don't forget the positives that could surprise you next year. 10% revenue growth, by the way, for the S&P 500. And most of that growth was accounted for by energy, and some of it pockets of healthcare and consumer discretion. So there were some real positives. Real estate earnings were growing up too. So that says it's going to be okay. Year by year economic forecast. 23 is supposed to be a 0.4% real GDP growth. What did I say? Growth flattens out or disappears, or at some points it may be slightly negative. But that says not a recession. In 24, it's 1.4%. Slowing growth, and then it starts to reaccelerate. I'm Spencer McGowan, President, McGowan Group Asset Management. A brainstorming session with McGowan Group Asset Management is the recommendation. Go to networthradio.com, contact us there, and we'll set your time for a Zoom brainstorming session, or you can come down and get the tour with my Texas Financial History Private Collection Originals and financial lessons built in there too. Thank you for tuning in to Net Worth Media today and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowan Group, Apple Podcasts, Net Worth Radio, and networthradio.com. The Net Worth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowan Group Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at networthradio.com for what we believe can help you make great decisions, the research that comes up. Now, the Net Worth Media effort is also designed to address cycles in the market, value at risk of loss. At networthradio.com, you can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowan Group Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.